Thank you for joining us on Minds of Commercial Real Estate. Today we have Gino again on our show. Gino, thank you for coming back on the show.
Listen, the first time came here was a lot of fun. We wanted to expand. You're like, time out. There's a lot to get to. Can I get you back on? So listen, it's an honor and it's a privilege to be back on because I could talk about real estate anytime, any day. So thanks for having me back on. I appreciate it.
We appreciate all of your insights for our future entrepreneurs in this
Thank you.
sector.
Thank you.
You got what I want, got what I want. You give me just one look and you know I'm good to go. You know I'm good to go.
So today we want to focus on market analysis and things to look for when identifying a property from what you research versus what brokers and agents tell you on a particular property.
I love that.
Yes. So let's go into particular about yourself and where your niche is. And let's take an example of a property you recently bought or are currently looking at and what you see based on your analysis versus what an agent or broker of that neighborhood is telling you.
What we try to do is let's zoom out. The first thing we need to do is we need to zoom out and we need to say to ourselves, the framework, once again, it's buy right, it's operate, and it's exit. That's the three-step framework that we're looking at from every deal. And now if we zoom in, we're looking at the buy right specifically here. And when we look to buy a deal, the first thing we need to focus on is just looking for a deal. Great. That's what most beginners do when they start out. That's the mistakes that I made. Let's focus in on the first part of the buy right criteria, and that is the market itself. You need to become an expert in the market. Now, that's the bad news. Camille, the good news is it's gotten a lot easier to do that. Years ago, it would cost me thousands of dollars in research, in data to subscribe to all of these different subscriptions. Now it's a lot easier. I just got a CoStar report from a broker in our Knoxville market. And let's walk through what you need to be looking for in this market because every market is different. There are different things going on in certain markets. Some markets are expanding with population. Some markets are declining. Up in the Northeast, rents are blowing up. Why is that? It's because they're not building there. There's not enough supply there, and there's still demand. Whereas in the Southeast and in cities like Phoenix, you have cities like Charlotte, Austin's a bloodbath right now. Why is that? They're still moving there, but there's so much supply coming on right now that the demand is there, but it's not coupling in. So when you're looking at a market, that's really important for you to understand and to become the expert. Because when I come to Camure and I say, hey, Camure, I'm looking for deals, I, as the investor, need to be able to explain to Camure why I can't pay this price. One of the ways you do that is by understanding what's going on, the dynamics that are going on in your market. In our market of Knoxville, for instance, rents are down 0.8% year over year. That's crazy. They're basically flat. So if a broker is telling you, yeah, you're going to be able to go 5% a year rents, you know right off the bat that you can't do that. So your underwriting already has to get pulled back. Number two, we know that we've had over 2,000 units delivered this last 12 months, but only 1,300 have been absorbed. That's not good. That's a telltale sign that's telling me why rents are dropping. The third aspect is right now, our market is 91.7% occupied. That's the occupancy right now. It used to be 95% 2 years ago. Now you're seeing this in real time. Those are all lagging indicators. You're seeing it happen right now because things aren't getting absorbed. Occupancy drops to 91.7%. So if you're going to underwrite a deal with rents at market, you can't put in the 95% occupied. It's not happening. It may happen 12 or 24 months from now, but you need to understand what's going on today. And I know the listener there is saying, well, Gino, I'm never going to do a deal if you're looking at it from that perspective. Hold on. That's the right way to do it because no deal is better than a bad deal. I don't want you to pencil whip a deal. You get a pen over here, you're whipping the deal up and making it look great. No, I want you to go based on facts. And the way you do it is by diving in to get a report of your market, the most current one. We use CoStar. You can go on. There's so many different websites where you can scrape data from. Berkadia's got a great site. Cushman and Wakefield, whatever broker you're working with, they will give you this information because they want your business. But looking at occupancy, looking at the supply of units coming online, looking at jobs that are coming in, all this data is so relevant. Looking at what rent growth is. Once you can extrapolate that and put that all together, you have a sense of where the market was coming from to where the market is. And I know from the data right now, the next 12 to 24 months for my market, it's going to be rocky. I can't make these assumptions that rents are going to go up. They're not going to go up in the next 6 to 12 months because we still have a lot of supply. We still have a lot of owners who are giving concessions. And the crazy part, Camiar, is in my market, A properties, the higher class properties, have a 13% vacancy rate. B's properties have an 8% vacancy rate, and C properties have a 7% vacancy rate. So when you break it down even more, if you're going for higher class properties, don't think you're going to underwrite it at a 92 or 93% occupancy. That's a pie in the sky right now. It's more like an 87. And you may say to yourself, well, what does a couple percentage points make? Well, when you're looking at a 100-unit property, a couple percentage points can equal tens of thousands of dollars of income.
Right. So there's a difference between how a consumer underwrites a file versus how a bank underwrites a file.
Yes.
And so I just wanted to differentiate that. When you're speaking, you're looking as the consumer, as a buyer side.
As an investor,
bank.
correct. Yes,
As the
correct.
investor.
Yes.
Huge difference. And so a bank or an agent or a broker is going to obviously tell you different things, but as you dive in and as you drive that neighborhood, it's going to be different analysis.
Yes, and that brings me to the second point, which is great. I don't know why I didn't mention this, but doing your analysis, let's extrapolate the buy right criteria even more. Now that you have a great understanding of the market, what does it look like for you as an investor? What kind of assets are you trying to target? For us in Knoxville, we like median incomes, like you said, driving neighborhoods of at least $50,000. That's a really good, solid working class, blue collar neighborhood where people can pay $1,200, $1,300, $1,400 a month for 2 bedrooms. Anything less than 40,000, it's a different, tenant resident base. We've had properties like that. They tend to have higher turnover, higher capex, lower price per unit. There's nothing wrong with that, but being clear and trying to understand what you're focusing on is important. So we have that where we're looking at, median incomes of over 50,000. We're looking for townhome style apartments. We love 2-bedroom, 1.5 bath townhome styles because for us, when we had a resident that comes in there, it feels more like a home. There's more space. There's more privacy. You usually sometimes get a little backyard. If they've got garages, even better. And for us, a couple of other things we're looking for right now in this part of the market cycle, we're looking for assets that are a little bit newer. The newer assets tend to have a little bit less capex. They tend to have a little less wear and tear. We tend to have to put less money into these deals. That's important. When you're pricing a property, you have to price in, as single-family home investors call it, after repair value. It's great that you bought a house for $600,000, but what is it once you've fully done all the work? That's the number you're trying to underwrite, and it's important. And I think the last thing that I would say about your criteria and you doing your due diligence is what kind of amenities do you want in the property? We like washer dryer hookups. If the properties have garages, if they have dog parks, if they've got pools, fitness centers, these are all things that residents like. If they don't have them and we're looking at that property, we just have to realize we may not get the rent that the property down the street has with those amenities. So that's why it's important to understand what your resident wants and how you're going to be able to price the property versus the competition.
Let's focus on that group that you said makes 50K or more. What is typically their turnover on those, and like how long are they leasing versus and before going and buying a property?
That's another great question. Years ago, when we had this 2020, 2021 craze, rents were going up so high that there was a constant turnover. You actually wanted to turn the residents over because rents were going up at a 10, 20, percent clip. In some years, we had a 15% rise in rents for 2 years. So the model back then, 2 and 3 years ago, 4 years ago, was we don't want retention because if we retain it, that resident can't go up that much. So what was happening was that these apartments were getting turned over a lot quicker. Now, that's where the focus is. When you talk to any operator, it's all about operations and it's all about retaining the resident. And for us, I had that shift around a year ago. I said to Jake, we really need to focus on retention. So to specifically answer your question, in multifamily, there's between a 40 and a 50% turnover every year of your units. Now, the goal as an operator is to try to create a community, to try to get that, that retention less. If you can keep that resident, keep him happy or keep her happy, you start building a community where people start liking to live there. They start having friends and other family members living there. That's the ultimate goal. And, the way you do that is, number one, customer service. And in my opinion, the second thing that you can do to drive that is maintenance. You want to have your work orders all closed up. You want to listen to the residents. When there's something going on, you want to have that communication. You want to be able to be proactive with the resident. And that's where, technologies like AI and texting allow you to stay ahead of these problems and be able to create a dialogue with the resident to make sure that if something's going wrong, don't wait for something to go wrong. Try to anticipate. Try to make sure that there's a communication between you and the property management and the resident.
Sure. Now, for let's say in Knoxville, echelon that it makes over 50, right? If they were going to buy that particular unit, what their principal and interest, what their PITI and HOA would be versus what's the rent would be, what is the difference?
It's insane. We're at the highest disparity between renting and owning, I think, on record, if not very close. On average, the US is like $1,100. It costs $1,100 more to buy a home than it does to rent an apartment. And it's around that number in Knoxville as well. To me, it's crazy because you think to yourself, well, buying a home is the American dream. And for some people, it's excellent. Household formation, starting a home, having kids, great time to buy. You have a little bit more stability. You have a little bit more of a long-term approach. But if you're a baby boomer and you want to retire and you're traveling, or if you're young and you're a millennial and you want to say to yourself, well, I don't know if I'm going to be here in 2 years in this city. Why would you buy a home when it's going to cost you an average $1,000 more and you don't even know if you're going to be there? So for me, I just see that disparity helping us out. But at the same time, isn't it incredible how beautiful the capital market system, the free capitalism works, where, hey, you want to get rents down, you want to take care of this inflation. That's why we don't have inflation. Build more. And when you build more, what happens is you're filling that void for demand. And when there's a lot of supply and that demand comes to fill it, we still have a supply-demand imbalance in our market. We still have more units coming on than people want to rent, even though over 30,000 people have moved into the Knoxville market in the last several years. We've got a lot of population coming in, but even with that strong demand, builders saw over the last 3 or 4 years, hey, cheap money, a lot of land. We see people coming in. Let's build, build, build. And now we're seeing over the last 3 or 4 months, permits just drop. So we're going to have that cycle where that demand is there. And all of a sudden the supply is going to burn out by the end of 2026, mid 2027. And that's where we're going to see over the next 12 months, there's going to be a little bit of pain in the market. But that's just to tell you, as you're underwriting deals, be very conservative over these next 6 to 12 months. There's going to be very little rent growth there, and the occupancy is still going to be in the low 90s. So just be aware of that in our market.
A lot of the markets have changed in general. I mean, speaking here in LA, I mean that it's probably that 1,100 would be somewhere in the vicinity of $2,500 to $3,000 difference, if not more, and depending on the neighborhood. So it's definitely the chances of buying baby boomers, even some of these kids that are making more income, they just don't look at it as a good investment anymore. They want to, like you said, they want to be able to move and just enjoy life.
When you're looking at buying a home, really, you need to have time on your side. If you're going to buy a home and you're not sure if you're going to be there for the next 7, 10 years, where you're going to be able to pay down a little bit of that principal, where you're going to have time and inflation help you with, the appreciation of the property, then you're taking on a very risky proposition. But if you've got a 7 to 10 year window and you're like, I'm going to buy this home, I'm going to be here for the next 7 to 10 years, I'm going to take care of this home, I'm going to pay down this principal, then there's a lot less risk. You're taking that downside risk. But very similar to bridge debt, if you're playing that time game and you're trying to time it where I'm going to buy a home now and I'm going to get out in the next 24 months, that's where there's a lot of risk. And that's where people lose money when they're buying homes for themselves as an investment.
Sure. During your due diligence, you mentioned something very unique. How new is the property? So when you're looking at a property after all the experience you have today, how old do you recommend the property to be?
That's a great question. It really depends upon the price. And if I can buy an old property at a very high cap rate and I can get it for an attractive price, I don't mind buying an older property. I don't mind buying a property that has aluminum wiring. I don't mind buying a property that has cast iron plumbing. I don't mind buying a property that has an old roof, but I can't pay a 6 cap for that property. I can pay a 11 cap or 10 cap. Then people are going to say, well, you're not going to buy it. Then that's okay. I just have to understand that if I'm going to buy a 1970s property that has Zinsco breakers or Federal Pacific breakers, I'm going to have to replace those, and those are costly. So it comes down to the price of the asset. That's why we're migrating and have been looking at newer properties in this part of the market cycle, because the B and C properties, their pricing has sort of like come in line where everyone was jumping into the value add C space over the last 5 years, and they bumped up the price, and the B properties stayed where they were. So there's a very little delta between both of them. So I'm not telling the person out there listening not to look at old properties. Just make sure that you have enough money set aside in your budget to take care of all of those items. You have your HVACs, you have your hot water heaters, you have your driveways, you have your decks. We have a 156 unit property right now that is in the middle of, we're changing all of the decks in ourselves. We have a CapEx crew that's going through and changing over 100 decks. If we had to sub that project out, minimum $6,000 to $10,000 per deck. We're doing it internally. It's an older product. It's a 1970s product. We bought it at a good basis. But these are things that you're going to have to understand. If you're buying a 1970s product and your idea is, I'm going to hold this thing for the long term, great idea. Just understand that these properties do get old, and they need some TLC, and you're going to have some money set aside for that TLC.
On this particular project you are mentioning, did you do bridge financing or did you do permanent?
This property, we bought it back in 2016, and we bought it for an amazing price per unit. Most other investors would have probably flipped out of the property and gone on and bought another property. We just saw it was in a great part of a submarket in Knoxville. It's in the west part of the city. There's a lot of demand there. It's just a beautiful property, 156 units. We like the unit mix. We like there's townhome styles, great amenities on the property, a lot of parking. It just looked beautiful. It was park-like, and we love the decking. We just love the property itself. So we decided this is a long-term hold. But when we bought it 10 years ago, we knew that these projects were going to come up. We've had so many leaks on the property. A 1970s asset is an old asset. A lot of copper, a lot of pinholes, but we've had that budgeted, and we've taken care of that. And for us, we bought it with community financing, and then back in 2018, we refinanced it to Fannie. So in 2028, it's a 10-year term. It's coming due in 2028. So for us, that's the idea. But if you're going to buy an old property, just make sure you have all these line items taken care of, or at least budgeted for.
Well, that's what I was getting to. So in addition to your down payment, to budgeting for that is also another out-of-pocket expense.
Absolutely.
And if you're looking to refinance that after you do all the TLC, it's better for the potential investor to go with like a credit union where there is no prepayment on the property, so they're able to get the new value, maybe recoup some of their TLC investment.
Camille, last time we spoke, we were talking about credit unions, and I was talking about 30-year AMs. We are in the process right now of getting 5.75% 30-year AM with credit unions. Origination fees are a joke. They're like, we've negotiated with them like $3,000 for a $9 million loan. I think we're going to have a 1% prepayment fee, but who cares about that? It's still recourse. We don't mind because we're the only ones, but it's phenomenal. It is an incredible loan for us. And when we bought these properties, we bought 2 of them with loan to cost. So we actually had 80% loan to cost, which means that 80% of the proceeds of the loan we were using for rehab. So we budgeted $1 million for rehab. 80% of that loan proceeds were put into the loan itself. So we drew them out. So that's another strategy that you can use it. If you don't have the loan proceeds, you do that. And if you're an investor like us, what you do is you just stop taking the cash flow every month, and you use that cash flow to pay for the property. So when you're ready to refinance, hey, that's where the bonanza is. That exit is where you make your money and you crystallize the equity. But it's important to follow through, because when you do go to a Fannie or Freddie product, or you do go to a credit union, they're going to go on the property and they're going to inspect the property. So you need to make sure that you put all the work in to getting that property up to snuff.
Right. And one of the major factors that you're considering today versus maybe 3, 4, 5 years ago wasn't a big factor is the insurance aspect.
Yeah, I mean, insurance has gotten to be expensive. The two biggest line items we have right now are their property taxes that are going up. There's something you can't do. So when you're underwriting a deal, make sure you have actual today property taxes and make sure if you're buying a deal today, is it going to reset next year? I mean, some assets reset every market's different. Some of them reset yearly, some reset every 3 years, every 5 years. So make sure how the county assesses taxes in your market. And like you said, with the insurance, we've been very fortunate in Knoxville because it's sort of weather reverse. You'll have hailstorm come through every 10 years or so, but there's very little wind. There's very little, no hurricanes, not that much snow or ice. So we've sort of been insulated. So we're around the $300 to $350 per unit in insurance in our market, which is actually phenomenal. It's a really great pricing.
That's phenomenal.
It is, but we don't have that many. We have really high deductibles, and we don't have that many claims because there's not a lot of weather events. There's not a lot of risk. Now, if you go to Mississippi, if you go to you go to parts of Florida, you're at over $1,000 a unit just for insurance. So that's what I'm saying when we're talking about the
Right.
market. You have to understand the market. That's not hard. Just get some declaration pages from, brokers or from the deals you're looking at. Get it and bring it to your insurance broker and make sure that they can quote that property and make sure that you get the proper coverages on that property.
Right. So we've talked, a couple different points, the due diligence, looking at the exact numbers. What is the market doing today? Getting the CoStar report, the insurance, the property tax. When we put this all together, what is your number one advice to viewers when looking at any particular property as as an investor?
The number one bit of advice that I could give to anybody listening to this is know why you're buying this deal. Know why you're investing in that vehicle. For me specifically, I always wanted multifamily because I saw it as a business. I saw it as a monthly recurring model. Everyone talks about MRR, monthly recurring revenue. And I said, well, that's what multifamily is. They've got to pay rent every month. We have additional fees on there, non-refundable deposits. We have, charges, lease expirations. We have rubs. So for me, that niche, that asset class worked so well for me. And so for somebody listening to this, I really want them to lean into whatever investment they love to do. If you love single family homes, don't let anybody push you away from single family homes. If you feel comfortable doing that and you like buying them and you understand them and you're making money, stick with it. I mean, if that's what you love to do, understand that. But you can still take the concepts that I've talked about today and apply them to your business. And once you become an expert at single family homes, don't be afraid to venture out and look at other aspects, other markets. Maybe it's self-storage. Maybe it is multifamily. Maybe you're saying to yourself, hey, I want to scale up and get more units under one roof. That's the reason why we started. We understood the scalability and the economies of scale through multifamily, but I'm not here to tell you that one niche is better than the other. So for me, the best bit of advice that I can give anybody listening to this is pick one niche, really learn it, pick one market, really become a master of it, and understand what it is, what goals you're trying to accomplish through this investing vehicle that you've just chosen.
Gino, thank you for the amazing advice. I hope the viewers can gain some insight and they can always reach out to either of us. Thank you and look forward to having you on a future show.
Thanks, Cam. I appreciate it.
Thank you for watching. If you enjoyed this episode, please give us a thumbs up, subscribe, share any questions or comments in the comments below, and follow us on social media. I look forward to seeing you next time.
Let's get together. Let's get to having some fun. Let's do whatever. The night's looking so young. Let's get together. Let's get to having some fun. Let's get together. Let's get together. Let's get together. Let's get together.